and we do a lot of referring back and forth with bankers. And we were sort of going through our pipeline, and you mentioned one of our existing clients and having just done a big credit facility for them. And I said, that's one of our clients. And he said, well, that one's got credit insurance on it. And it was just sort of a throwaway comment. And I came back to the office and I got with my broker and I got huddled with Garrett. And I said, what the heck? I mean, can we become the broker on it? Because we service all their other products. And, the answer was yes. And sort of happenstance as things would work out. We became the broker on it with Euler Hermes in fairly short order because we've got a great relationship with the client. And so it just really spurred a lot of conversation around our sales table about, wow, this is something, that most of our peer firms don't even know anything about, which we like because we're a very specialized shop. For those of you who have not met, we're about a 100-person firm. We got started in 2003 with about 12. So we've had a pretty rapid growth rate as well. And it's been fueled by specialization in industry verticals. I mentioned the transportation logistics. Obviously, we've got a huge commercial construction practice, which includes a big surety bond group. We've got a huge professional services business, which is kind of focused in the medical services primarily, but also we do a number of architects and engineers, accounting firms and attorney firms as well. But one of my original partners was a hospital administrator, so we're neck deep in the physician and surgeon arena. We've also got a large real estate practice, which includes hotels, apartments, office buildings, and so forth. Hospitality on the restaurant side. We have a partner that writes 300 restaurants from multi-location franchisees to high-end white tablecloth. But we're a very diverse firm, and this really fits because we try to really be specialists in what we do, and this is very consistent with that. Very pleased to have Tyler do the program for us. Before he got into the credit business, he was actually a professional baseball player, so you may recognize him. He's a graduate of Georgia Tech, and has been with Euler Hermes about 4 years, selling this credit insurance. So appreciate it. Appreciate your attention and your time. So thanks very much, Tyler.
Thank you. Again, just with the size of the room and the people involved, let's keep this pretty informal. Anytime, any slide run, any question you guys have, please reach out. I'd like to keep it more interactive than just PowerPoint you to death. Depending on how familiar you are with credit insurance, dig in whenever you see an example or a question or a client or a prospect or a banking relationship that you might have that this might be a fit, just to say, hey, they do this. Can you guys be an asset to them? So this is just our overview of what we're going to look at right now, the shareholding structure, who we are, things that we do, basically what is credit insurance, which is my first question when I sit down with people, have you ever heard of it? Are you familiar with it? Whether it's a bank or a broker or a prospect and going after direct anything. Because they might think they know what it is, and they might have absolutely no idea. So again, like it was mentioned, Allianz is our majority shareholder. We do trade publicly on the French Stock Exchange as well. But all of our reinsurance goes through Allianz, which is, the largest insurance company in the world, one of the largest companies in the world, period. So we have a good, strong backing, AA- by Standard & Poor's rating as well.
From a U.S. perspective, many of y'all have heard of Fireman's Fund, and they bought Fireman's Fund a number of years ago, so that'd be the American brand, and be familiar to people.
This is the proximity to risk, or basically sometimes we'll say this is the economic intelligence or what you pay for when you get with us. It's not so much of, an insurance or I don't have any losses, I don't need insurance. It's these blips right here, these are our offices that are located around the world. So if you're looking to sell to somebody in Turkey versus, Decatur, we're going to have a brick and mortar office there with underwriters, with the ability to see what the heck is going on in that country. Because I'll talk to people that if they're growing, and they're growing internationally, they might have never sold to any of these countries, Saudi Arabia, anywhere. and they don't know if it is a guy out of his truck or if it's a solidified company looking to buy $5 million of their widget. So we do. So what we're saying is they're looking at these companies as they're growing, as they're adding. We'll say, hey, is there ever a moment where your salespeople come into finance and say, hey, there's an opportunity I have with ABC in Bangalore. I have no idea. That's what you're paying for with us, is we can look them up, and I'm always blown away with how much information we have in our database. And again, that's what I talk about when I talk with people. This is the actual Americas figure, $300 million in revenue, including these countries right here. It's the oldest and largest credit insurer in the world, 1893. What I like about that is in Georgia, I believe it's 3 years before Coca-Cola started. So when you talk about that with your clients in Georgia, that kind of rings true. They'll say, how long has this company been around? Because they've probably never heard of it. And you say 120 years. They're like, oh, instant credibility is built. We've been doing this one product for 120 years. So it is, it is a good history of this company in America. It's not just a European, international, global company. Same figures in Canada. Our Canadian agents always want us to make sure we included something specific to Canada, as we had it on there. Exact same largest privately held credit insurance in Canada as well. 1923, so only 90 years in Canada. But some of the awards, this just speaks to where we are. Saudi Arabia, Italy, Turkey, the UK. So Brazil, which is kind of rough right now. But if you're looking to, again, the proximity to the risk, everyone that is utilizing these services around the world is we're known as far as if someone is in Western Europe especially is trading with somebody else, they're utilizing credit insurance. And it still feels like a 120-year-old startup, sometimes we say, in the United States, just because it's still very evangelical when you're talking to people. You still have to kind of let them know what it is, and they say, wow, how have I never heard of this? When I talk about what actually is the credit insurance, this is kind of the offense and the defense of how people are utilizing it right now. The defense side is the coverage and the monitoring for the defaults, the insurance side of what we do. Slow pay, no pay, bankruptcies, Chapter 7, 11, 13, things like that. If someone on your portfolio files for bankruptcy or you file a claim on a slow pay, we're there to pay out the money, and then we'll use our collection side to continue to get the money for ourselves, but your cash flow stays like this and you're made whole. So yes, the insurance side is very easy when I talk to people. It's, yeah, here's your portfolio, here's who we're insuring. From a banking perspective, here's the percentage of AR that is now insured versus before your largest asset was uninsured. That's the easy part. The side that we've seen so much with how much the economy's been growing now, it's stifling off now, but the knowledge to pick and keep the right customers. So again, if you're not having any losses, it means maybe you're being a little too conservative with the people that you're trying to take on. So that is an avenue of how people are looking at it as, I don't have any losses, well maybe you're being too conservative on the front end. Or, as I'm looking at new people or new verticals or new geographies, new people that are trying to buy what we do, we're gonna know who that person is. Maybe you're not, if I'm talking with a carpeting company, they were doing carpeting, but they would print out designs on the carpet. So that, in Dalton, it's smaller family firms that have been selling to each other for 100 years and pass it down to grandsons. Now, these people were looking at embroideries going into catalogs. They know everything there is to know up and down the supply chain of carpeting, the glue, the fabrics that go on there, who it gets shipped out to, who the truckers are shipping them out. They have no idea who these catalog people are that want to start buying their products. So they're saying, this person want to buy a good amount of what we do. What do you think? And that's what we do. I can tell them, yes, these people are insurable. 5 other policyholders have coverage on them right now. And as much as I'm allowed to tell them versus they're public or private, I can give them a very good idea of, go for it, hit the gas and keep going with these companies and tell your salespeople to bring you another one. Or, on the contrary, how long does it take them to make a credit decision? I can let them know, do not extend terms to this person right now. And here's the reasons why. With the, I just have a bankruptcy list, but there was a person that had a big opportunity with Sports Authority that I was talking to, selling flashlights. And they are selling to this and this and this. And he said, well, I've got a $200,000 order pending with Sports Authority. I think this was 4 months ago. And I said, look, do not take that order. Okay? They're weeks away from filing bankruptcy. Salespeople are very confident and very optimistic, right? hey, I've got this opportunity with, they're going to buy it, they look, they're fine, they're not, people still talk to us about Sears. Yeah, I know their stock is down, and they're looking at, but they're still fine, they're still paying their bills, things like that. It's the blind optimism sometimes of, and again, I was like, even if you don't buy this from me, do not take that order, I'm begging you. And then, a month goes by, and Sports Authority files for bankruptcy. So.
And have since decided to liquidate.
Right.
One thing I'll add to this, and whether you're a bank or broker partner trying to explain this, or if you're thinking about this for your own business, the key message of this is that we're not reinventing the wheel here. We insure an asset. Every company that we meet with has chosen to insure assets in their business. Historically, they just haven't looked at the accounts receivable as one of those assets to insure. So as far as what credit insurance is, it's not rocket science. We put a guarantee on the value of the accounts receivable in the event of loss. Where we spend most of our time and where the true value lies is in the practical applications of the insurance on a day-to-day basis. It really is unique as compared to many of the other kind of casualty insurances that you buy. The ROI for our product is rarely defined through a claim file. We all know how insurance works. You pay, something bad happens, I pay, and then we start the cycle again. And it happens with us. We pay tens of billions of dollars in claims. We pay a lot. But the day-to-day applications of the product are what Tyler's talking about now. How can we help a client grow their top line? And how does the subsequent revenue from doing that offset the cost of the premium? Can we impact their capital relationship with their bank, their ability to borrow, the amount in which they borrow, the rates in which they borrow, and how does that affect how they run their business? Those are the things we like to spend our time talking about with the client. And oh, by the way, if something bad happens, we're there to write a check as well. So if you get anything from this slide, it is, we don't want to make this complex. The applications utilized by each and every policyholder are somewhat different, but the concept of what we do is really relatively simple.
And I would think a lot of the value in it, and correct me if I'm wrong, is just the information you're able to get to a client, not just the insurance piece.
Right. Yeah, especially if you're in growth mode. I mean, think about it, you have two options. And we'll just use the example because it's been relevant in the marketplace of a small to medium-sized business that's never exported before, but they've decided to start venturing out outside the United States to peddle their product, if you will. A couple of things you can do. You can totally mitigate risk by requiring cash in advance or letters of credit, which can limit your ability to compete, but they do mitigate risk. The other option is to build a robust infrastructure. You can hire a credit team of 15 people that have global expertise, and you can develop partnerships in all these markets to collect your money should anything go wrong. But I think most would agree that that's a relatively expensive venture on its own, especially with the uncertainty in the economic landscape and the political landscape domestically with building this huge new infrastructure. So your third option is find somebody that's done it for 125 years and let them do it for you. And that's really the value that you're alluding to there. Tyler showed the map earlier, we've got brick and mortar in 52 countries. We write coverage in more than 200 foreign markets. We've got 6,000 employees that do nothing but underwrite and monitor risk associated with buyers. This is all that we do, and we've built our own infrastructure to support it.
So again, like Josh just stated, the first and the most significant way to discuss this with people is to get away from the fact that yes, we are an insurance company, but we are an accounts receivable manager. We're managing and making credit decisions all day long. So the sales expansion piece, this is a good out-of-the-box explanation of when you're talking to someone. Have you reached comfort levels with certain clients where that's as high as you want to go? And let's say that for this example, $40 million company, $6 million typically outstanding in AR at any given time. They're on 10% margin, so they're going to turn that AR 8 times in the year. Okay? If there's a certain, this is one account, right? One buyer that they have, which typically can show the ROI for what it is. They've got a $500,000 credit limit with one customer, but they could potentially sell up to $750,000 at any given time, but the finance department and the sales department are always at different ends of the spectrum, right? And the finance department gets viewed as the anti-sales department and hates it because they're doing their due diligence and seeing what the risk is and looking at things in a bigger picture than on the sales side. But if we could mitigate the risk and we could take on the risk, could you potentially sell more to these people? If I'm in a meeting and I have the director of finance and director of sales, that's going to be a fantastic conversation. Has this person ever stopped you for making money for the company or anything like that? Of course, they're like, yeah, this one, you'll just rattle them off. So this is a prime example of that. $250,000 sales potential at any given time. Basic math at 10% margin. I turn that AR 10 times. So if I turn the extra incremental $250,000, if I turn that 8 times in a year, that's $2 million in revenue. Again, get them to buy. What's your profit margin? 10%. I just made you $200,000 in gross profit. My premium's going to be, $50,000. So that's the example. That's one client of the sales growth tool that you could. Have you turned away one person? Typically, they're going to say no if I'm talking to the CFO. Have you guys ever turned away business? No. If I went to the sales department, would they have a different? Okay, well maybe a couple. But you wouldn't have insured them anyways. Don't be so sure. Maybe I know something you don't know. That's all we do.
Inevitably, if you meet with a company in this environment that says they experience no losses associated with their accounts receivable, then they're either lying to you or they are missing out on revenue opportunities, because that model doesn't exist. Barring the fact that you're heavily concentrated with 2 or 3 accounts and then your business model every year is kind of an all or nothing model. An average medium-sized business, we're just not operating in a domestic economy right now that allows for a sales growth appetite without any loss. It just doesn't exist. So no matter what they tell you, Tyler's right. You go ask the other side of the fence, and the right answer might be somewhere in the middle. Exactly. The salespeople are wrong sometimes too. It is a bad opportunity, and you run like the Sports Authority example. But if we're right 30% of the time, what does that mean to profitability in the organization?
This is the exact same slide. Just if you're talking with someone, these can all be interchanged. So I'll have this in an Excel sheet if I'm speaking with someone that I can type, what do you do in annual sales? What do you sell in 30-day terms? Yes, you turn that AR 10 times, right? What's your profit margins? 10%. And it can come out down here to exactly how many new customers that you could utilize that could pay for the premium. So if I utilize this program, if I could find you one new client at a $50,000 credit limit, then that would pay for the premium of the policy. So you just get them to kind of buy into what it is, and you can plug in their numbers or anything that they're looking at. And like I said, it is a perfect middle of, yes, maybe the sales rep's looking at Sports Authority, but also maybe they're looking at something that CFO is just not familiar with. Or they might, call the people in their industry and they have a bad, taste in their mouth from something that happened 10 years ago that someone else they talked to, or the bank and trade references, all those things don't add up. Maybe we have something they don't. Maybe we have their financials on file. So this is a case study, freight logistics company. When we were looking at, the logistics market for us is actually absolutely exploded. Just due to the fact that the need for quick, sound credit decisions is absolutely crucial to what they're doing. They're on very thin margins. They have to make decisions quickly and they have to be right. And if they're wrong, it takes a long time for them to get back in the black because their margins are so small. So they'll either do 2 things. They'll either turn the risk away or get into it and get burned. And you don't want to say turn it away because, like I said, maybe sometimes they're making the correct decision. But if they use our database of 50 million customers and they can type something in and get an answer in instantaneously or 24 hours at the max, especially if it's a domestic company, they're pairing up this truckload with this. ABC company, $50,000, enter. You're going to get an answer, approved, go. Now that they can instantly start selling on open terms to that person. When I went to the trade show for the logistics company, it was people just coming up over and over and over and over with ideas for clients. Thank you so much. This has been great. They're just ripping through the day-to-day processes of credit insurance. It's not the insurance aspect of it, which is there if there is a default. It is the decisions and the ability to make quick, sound credit decisions with a guarantee behind it. That's how these people are utilizing this. And it's been, they truly see they're using it every day. And those are the ones that we want to see. If they're not adding policies, this is not an insurance where you put it on the shelf and I come back in a year and we sit down and renew it. They should be adding buyers all the time to the policy. Changing limits, hopefully, if their salespeople are doing what they're supposed to do.
Successful industry sector for us, by the way, if any of you are involved in it. I know you guys, you said you have a really large practice. They were early adopters, kind of got it pretty quickly, and subsequently we've become pretty involved in the TIA and a lot of the trade associations, do a lot of membership incentives and programs, so we're intertwined into that industry sector in a way that we've had a lot of success.
Yeah, when we were at TIA, the people that were coming up, there was another person that was with us, and he kept saying, "Hey, that's a policyholder. Go talk to them. That's a policyholder. That's a policyholder." And it was amazing.
Do you see a lot of people getting out of factoring, using credit insurance?
Right. Or using us as an augmentation of them, keeping the factor. But yeah, I mean, some of our customers are factors, but it's a lot less expensive. It's a different aspect of us insuring the receivables versus buying the receivables outright. But
we're seeing a lot of companies that, and this factoring has a place in the market, and we do a lot of business directly with factors and associated with the factoring marketplace. But as it relates to transportation specifically, so I'm not going to alienate anybody, but as it relates to transportation specifically, a lot of the transportation companies we've encountered have factored out of necessity, and it's not always the most cost-effective way to gain access to capital. And in many cases, credit insurance has been that one additional tool, especially for brokers. They don't have a lot of hard assets. The receivables are their assets. This has been an invaluable tool to get them out of what has historically been a pretty costly factoring relationship and into a more traditional ABL relationship with a commercial lender or boutique lender, and bring their cost of capital down and allow them to fully utilize that piece of collateral and borrow against it.
At what point do you deem an AR uncollectible? I mean, how do you determine, is it 30 days, 100 days? What are the criteria that goes into that decision?
right, that would be the maximum claim filing period. Is that what you're? If someone's on 30-day terms, on day 31, if someone wants to file a claim, they have the ability to do that. We obviously don't recommend that they do that. But then outside of that, it would be 90 days from due date or 180 days from ship date, whichever is longer or more or advantageous to the client.
So we'll put maximum parameters, but we don't put minimum like waiting periods. The
Right.
reality of business is you like to try to salvage that relationship with your customer. We don't get many day 31 claims. You file a claim when you're ready to sever that relationship. You just want your money, and then you want that client to become our client. So you make the decision, depends on the length of your relationship. It could be day 45 or it could be day 145. A lot of it will be determined by your communication with your clients and so forth. So.
And they can use us as the bad guy. When they're talking to their client, they're, hey, yeah, I've got the money, I need 15 more days. They know that they have that sleep at night insurance of, okay, but in 21 more days, I got to turn you guys over to Euler Hermes. And that creates a lot of payment, a lot of time. So they, again, will push off the bad guy aspect over to us. They know that they can let that person get their ducks in a row, and they know that they have that stop loss time frame of the 180 days to make sure that they get the payments in there.
From a banking standpoint, though, generally, if our policyholder is leveraging the policy as a means to enhance that lending relationship, the bank becomes an assigned, endorsed beneficiary to the policy and have all the rights of the policyholder. So if there are other reasons that would move the bank to pushing the claim earlier than the client might otherwise want to file, you certainly have that right from a banking standpoint as an endorsed beneficiary. You have all the rights of the policy. So longer than you do, based on
If
what
they
you're
want access to their line of credit.
Right. Forget the working capital. So this gets into the finance aspect. This is one example of what it is. If there are concentration issues with clients with a large amount of the portfolios and a few key accounts, so depending on how strong they are, there is still a concentration issue there. So this can help alleviate some of those concerns if that AR is insured. And borrow against the export receivables, this is the math on the ability to borrow against the export receivables. If someone does 40 million in annual sales, and 10 of that million is actually to the export, but right now the bank won't lend against the export receivables, by utilizing the credit insurance and using us to get creative to get a deal, to take it away from someone else, or like I said, the ABL lenders or any traditional banking aspects of what it is, they can will they lend against the export receivable if that AR is insured? That's kind of the question that we'll have to ask to those clients and things of that nature. But it frees up the working capital and gives you that much more dollars when you can be able to lend against the export receivables. Do you guys see that at all, or is?
Yeah, we do that well.
Okay. And
This has become, just FYI, and I know we've kind of got a mixed room of what everybody does here. This has become, I would say, in the last decade or less, one of the key benefits of credit insurance. About half of our policyholders in the U.S. do have a lender tied as a beneficiary to their policy. In some cases, that's why they looked in credit insurance. In some cases, it became kind of an after benefit. They bought it for some other reason and then realized they could recognize this benefit. But it's become really, really heavily utilized as a benefit of credit insurance in this market as access to capital has become a bit more constrained and the perceived value of receivables has diminished a little bit in a pretty volatile marketplace.
And the same thing on the private equity side, the merger and acquisitions, if they're looking to buy that company on the buy side or the sell side. This gives a true dollar value to the largest asset that company has, their accounts receivable. It says this number is now insured up to X number of dollars, so it can help the bank get more comfortable with the deal if they're this close with the bank or on the buy side or the sell side. They've been utilizing that a lot. And again, those, depending on who it comes from, if the bank is requiring it to that client, and those deals happen obviously very quickly, and then it's my job to talk to that client about the day-to-day other benefits of the sales expansion and get them into the policy. But in the meantime, the bank is happy and the client is happy.
That's one more comment I would say. 99% of banks are going to exclude foreign AR, except for maybe for a few companies, Germany and Canada, from their borrowing base. And so if a company has a heavily, or they have a seasonal business that has exports, if they want to utilize those AR against their borrowing base, they have to get credit insurance. I mean, that's the only other way around it.
Right. And then sometimes they'll say that to those clients and they'll say, what the heck is credit insurance? And then we have to sit down and go through it. But that's, like I said, it is a very 120-year-old start. This is this talks about the gap in the pay amount. This company has to pay their mills in 10 days, but they don't see payment from their customers for another 30 to 60 days. We've seen that go out. So they need to have a line of credit with their bank to make their business work. So this gets everyone comfortable on both sides. Same thing in logistics, same thing in staffing. Staffing companies is huge. When you're talking to someone and they have to pay their employees out and they're getting slow paid on the back end 60 to 90 days, they're going to be hesitant to take on any new business because they're already barely balancing on what it is. So it's not that they don't feel like they're turning away business, but they are because they can't push it anymore. But if they had us to let them do, like I said, the insurance side, sleep at night, make sure I know that what I have is insured, I can safely and aggressively grow to where I want to go.
So even if that staffing company has a bunch of relatively small businesses on the other side, that's
exactly.
very insurable.
Perfect client for what we do.
So the spread of risk also is a factor, I would imagine, for y'all.
Yeah, I mean, our ability to get, when you talk about businesses that are doing, most of what we do, we often say we're not that dissimilar to Standard & Poor's. We just do it for privately held companies instead of publicly traded companies. So most of the insurance that we extend is on smaller privately held companies. We do some Fortune 100, Fortune 50, Fortune 25 business. But when you get to that level, everybody can kind of analyze the same information and make a decision. Where we really shine is in the smaller privately held companies. And our spread of risk is different than that of our individual clients when we look at our global portfolio. So a lot of times that helps us increase our risk appetite. And Tyler's right. Staffing is a great example of a company that has to pay its employees weekly while, depending on who their clients are, maybe getting paid every 30, 60, 90 days if they're doing staffing services for large companies. So there's always a float. And what are their assets? Their receivables, really nothing else.
That's it.
So it's what they have. This has become a very prominent application for them and in the industry.
The export sales we've discussed a little bit. This is another company that I like with this forestry product CEO. Whether your potential buyers in Texas or Lebanon, you find there's always information in Euler Hermes database. I'm always surprised at what's in our database. When they're saying, we're looking at someone in Angola, like a $400,000, I'm like, man, I don't know. And then I look it up and we've got information all over the place. I'm like, yeah, they're insurable. We've got 2 other policies. They're like, really? Yeah. So that's, again, that's what this CEO saw the potential of, is when they're in the position of extending credit to a new customer, the decision can't wait, but it also can't be reckless, right? So they are using us for the economic intelligence of whether they are in tech. So don't shy away from, domestic receivables are just as risky as international receivables. There's good buyers in bad countries and there's bad buyers in good countries. So it's not the pigeonhole of just the export receivables. Domestic can be just as risky and come out of nowhere like anyone else, like a Sports Authority or Target Canada, something like that. Some of the other keys with the exports of the reasons why banks won't lend against it, it eliminates the need for a letter of credit. You can sell open terms overseas. I'm talking to someone, would you have a competitive advantage if you could sell open terms overseas versus requiring a letter? Absolutely. I will insure the receivables. I know who the buyers are you're trying to sell to. You can sell to them on open terms overseas and have a guarantee behind it. So unless they're selling something that nobody else makes, if they're competing with somebody else and they're selling their little metal fasteners to other countries and someone else does the exact same thing and they can sell 60 days same as cash, they're going to get the deal. Automotive industries, where they're selling to these clients, where they're making them do different terms or struggling with that. If I know the buyers and we guarantee the receivables, that's how it's a sales growth tool. Yes, could you get more deals than that? Yes, I can. Great, go get them. It's guaranteed. Go find another one. The debt collection side is, again, it's the ability of the company, when the rubber meets the road is when a claim is filed, right? So that is the talk track that you'll kind of get down a rabbit hole with some people of, okay, if I do have to file a claim, can you walk me through that process? And basically it's to get your money in 60 days. We're going to try and collect that money for 60 days with a 15% collection fee if we're able to collect. If not, then that company that claim is a defined insolvency against the policy and we pay you out a stroke of check. We're going to still try and collect the money, but in the meantime, you've been made whole. And again,
60 days.
Right.
So if I wait 60, I file my claim on day 60, I'm getting my money on day 120, worst case.
Right.
Worst case, it could be settled.
And that's 85% of your money?
Right, if we're able to collect. If it goes to the other side, then it's 90% indemnity, 10% co-insurance. You have a $100,000 claim, we're going to pay out 90, your share of risk of that is at $10,000.
It's an either or scenario. And we want to be an end-to-end solution for the policyholder. There may be some customers that choose not to insure their entire portfolio, or let's face it, they've got business that existed before they became a policyholder. We can also provide these debt collection services outside of the insured portfolio. So even if it's not an insured receivable, we can support them from a global debt collection standpoint. For the insured portfolio, if they're not an insolvent buyer, yes, we're going to take that 60-day period of time and try to collect. Depending on how long they waited to give it to us, our success rates will fluctuate. If you beat it for 179 days and then hand it to us, the odds of us collecting it after you waited 6 months is probably relatively low. Some of our policyholders choose to use us a little more proactively, but we've got a global network of attorneys and collection agencies that collect locally for that money. That's always a concern whenever you have a domestic company looking to export is, hey, if I'm selling in Decatur, to use Tyler's example, I know how to go get my money. I know what to do. I don't have those same options from a collection standpoint in global markets, and we give you those options.
This is just a snapshot of the risk map of the countries, and we have the country rating systems of who they're selling to, and they're looking at, and they're, a couple of years ago, they're saying, hey, we're looking at some growth in Brazil. And then now, this is always being updated, and I'll send this out to brokers and bankers a lot of times, just if they're having discussions with people, just so you can take a look at or ask me, hey, what's going on in Turkey or what's going on here? Again, I can look up any information, give you a ton of information on the grading, why it's graded that way, strengths and weaknesses, what's going on, what's in the forecast, what does the government have to do with it. All of these scenarios are in this risk map. You can download it on the app as well. There's the Euler Hermes app. Take a look at the country risk rating and take a peek at it. If you're talking to someone, just pull it up and take a look at it. Reduction in bad debt reserves, this is always another good math example that I like. Do you keep a bad debt cash reserve on hand for, in case of a bad debt loss? A lot of times they will. If they're a publicly traded company, if I look at their 10K, they'll have that in there. We see that this is a loss that could happen as the accounts receivable here, or the international accounts receivable could go default at any time. They know that that is a risk that they're taking on themselves, and sometimes you can see how much they keep in bad debt cash reserve. So if it's a smaller company and they're doing a $200,000 bad debt cash reserve, and my premium is only going to be $30,000 or $40,000 to insure all those accounts receivable, I'll ask them, could you do anything else with that money? Could you add it to the bottom line? Could you invest in whatever prospect your salespeople are asking you to invest in? Could you do anything else with that, free up some money for it, and you could utilize it? Or make yourself look more bankable by adding it to the bottom line? Yes, absolutely. And then in the meantime, you get all the other benefits of, and also if I had the cash reserve, if I have $10 million outstanding in AR at any given time, and I have an $800,000 bad debt cash reserve, I mean, that's a pretty large company with a pretty large bad debt cash reserve. I'm only 8% insured. So it's not going to protect you against the catastrophic risk protection, which no one sees coming and no one expects. You know, I don't have any losses. I only sell to big companies. They're, you know, they'll rattle them off to me. We only sell to big companies. It's not the little mom and pops that are going to go under. Larger companies can go under just as quickly as well as some of the small ones, and they might blindside you more so, like Target Canada, right? So this, even if I can only to insure 70% of AR, I get your whole aging report and I can look at the exposure. We insure 70% of that portfolio. Now the bank knows that 70% of the AR is insured. The client knows they can do something else with that money. So if you do this right, this product, it should not take $1 out of the budgeting scenario. We're like, yeah, we're running budgets and we're going to see if we can charge this. If we set this up right, and if you can add one new customer, do something with a bad debt cash reserve, or get a better rate from your bank, this is all money going back into the company versus if there ever was a loss, which they do have, and they say they don't, it might be, we just had one for $40,000, it really wasn't that big deal. That amount of time for that loss, I mean, that's straight profit out the back door of the company, right, when they have a loss. This product that we sell, if you say the same $40,000 for a credit insurance policy versus just had one loss for $40,000, it's a completely different number to look at versus the investment and getting the return on investment or just money flying out the back door. So keep that in mind.
One thing I'll say, because we've gone through a few of these things, for most of our policyholders, it becomes a combination. Now, some of them there is a magic bullet. You know, there's one customer. You know, we went through this. I remember one that happened early this year. They had one $500,000 order that they weren't going to take. We insured it. The profit. They were a heavy margin company selling into the retail industry space. It was a no-brainer. So sometimes there is that one magic bullet. But most of our clients start recognizing benefits in multiple areas. That's why we talk about so many of these. And the bad debt reserve, I don't know, it's just kind of a historic way companies have done it. Sometimes it's not even about losses, it's just about a fixed percentage of revenue. But 9 times out of 10, it's still not enough money to do any good at all if their largest customer were to file for bankruptcy. So you end up tying all this money on the balance sheet that's really insufficient to help you if anything unexpected happens, but you can't do anything else with the money. In most cases, we can replace that with a credit insurance premium that's a tax-deductible insurance premium, first of all. Free up some dollars that you can do other things with, and it protects you against the unexpected. So the numbers will float however you want to float them, but you get more protection for less money if you're a company who has historically protected your business through bad debt reserves. This is just a better way to do it. That's a professional services company.
Right. So this just talks about the percentages of your asset. This is the only asset that's typically not insured for a company. Now this shows 80% of the company's assets or receivables. That might be a little high, a little aggressive. This one shows more like a 40% portfolio, but it still speaks to what it is. You have insurance on your machinery, on your trucks, on your executives, on the cash that you have, on the building, fire insurance, every other type of asset that you have is insured. But the one with revenue tied to it, the AR, the most valuable asset that you have, your accounts receivable, is not insured. And when you just say that out loud to a client, you know, you see this is the only thing you don't have insurance on. Yeah, I guess you're right. And this is the one that has, this is unpaid invoices, that's all it is. You don't have insurance on unpaid invoices. If I'm selling diapers into a retail space and that gets delivered for $400,000 of equipment and then that Target can goes out, you're out that money. Not, you got insurance on the truck that had a wreck or anything like that. It's always interesting when you just blatantly show it to someone and say, do you see that, do you have insurance on all these other aspects? Yes. And this is by far the largest wedge. And where does AR fall on on the balance sheet? Those are good questions to ask the client. This just talks to the math of the effects of a bad debt loss. Like I said, $50,000 loss at 6% profit margin. Profit margin, not profit. You got to get $833,000 in new business brought in to break even. CFOs love, you can scare tactic a CFO when you do that on this.
Y'all ever insure receivables from municipalities?
Sure. Yeah.
Okay. Because, California's had, I don't know how many cities.
It's funny.
Yeah.
And we've had some issues with, we do a lot of contracting and, we've got clients that work for municipalities and historically that
We've
was
seen
always.
some major municipality filings. I think the largest in the country was over in Alabama.
Birmingham.
7 or 8 years ago,
Jefferson
there was
County.
the question, can we exclude municipalities? We're not really worried about that risk. Now the question has shifted.
Right, can I
Can you
get them
include my
insured?
municipality? Yes, we can. The only thing we won't insure is direct business with the federal government. Doesn't change that very little business that we encounter is done directly with the federal government. We do a lot with contractors that are getting paid by a contractor for a federal government project.
That's my question to you. So we have a lot of subcontractors, and they're pretty much forced to sign a contract that's pay when paid from their GC. So the credit is not really the GC, it's one step above
Yeah.
that my subcontract client doesn't have a relationship with. Is there something that you guys can help with that, or how? Tell me how that would fit.
Yeah, a big part of what we do is using our infrastructure to determine how sound that pecking order is, that supply chain is. Is it ultimately responsible from the federal government? How do we dictate terms of the policy in doing that? We do a lot of commercial construction business, and that's a very common scenario. Some of the policies...
Even if the government is the ultimate payer.
Yeah, we don't have an issue with that. From a,
Because
Maybe I would
we've seen is the
disagree with
VA
you.
is
Sure.
not
Yeah,
fair.
Yeah.
I might disagree with it, but yes, if ultimately we know the federal government is responsible for funding the project, I think we know that it's probably going to be slow, but the probability that it's not, that a federal government insolvency is probably pretty low. The greater risk for a subcontractor is just because the GC gets paid by the federal government, what happens in that middle step before they get their money? Have they overextended themselves? Could it be misappropriated or mishandled?
So you have the developer hires GC and the sub, does the sub then have the ability to say, I'm gonna do a $500,000 job for XYZ general contractor, but I really want to know about ABC?
Yeah, we insure so we need to insure who they bill. From a legal standpoint, we insure who they invoice. Now, as part of our underwriting due diligence, to determine whether or not we're willing to insure that GC, we're going to look at the money trail. So who is the GC funded by? Are they funded
So
by?
you might fund a GC on one project, but not another? right?
Potentially.
Yeah.
Right.
Potential clients are. Got it.
And we see this in foreign markets a lot as well, where, we've got, part of my region that I cover, South Florida, is part of our southeastern region, and we do a lot of business in the Caribbean and Latin America, and we do a lot of business with contractors that are responsible for doing projects in some underdeveloped markets in Latin America and the Caribbean. So a big part of what we look at, are they building roads funded by the federal government, or are they doing privately funded projects that inherently carry a little more risk? And it's part of our underwriting due diligence. Ultimately, the credit limit will rest on who the responsible party is for paying the invoice to our policy.
Okay, one more. So we have a developer, and they'll start a new LLC for whatever this project is.
Yeah.
And we got different players and different cuts, and then a bank loan, right? So how do you guys underwrite this new LLC?
Yeah, realistically, it can be tough, and a lot of it depends on the credit limits we're looking to underwrite. So if you're looking for a $5 million credit limit on a new LLC that just started last week, they better be willing to have a conversation with us about their history. So what would you, I understand that you're starting, once again, we see this a lot with projects. We just tend to see it a lot in South Florida where banks or companies will set up special purpose vehicles strictly for the function of one transaction. So we're used to that structure. We're okay with it, as long as we can understand the back end of that structure.
You
Who's
insure a fair
funding
amount of that in
SPV?
South Florida?
I'm sorry?
You insure a fair amount of that
Yeah,
kind of thing?
significant amount.
I mean, there's a similar structure here on
Yeah, okay.
developments.
Yeah, as long as we can understand the back end of it, that's what's crucial. Who are the players in the transaction? Who's funding the transaction? How much can we understand that? We've seen a lot, especially in the financing space, of reverse factoring transactions, supply chain finance transactions that are looking to credit insurance as a means to secure that. And it's become probably one of the fastest growing and largest premium opportunities in our business, especially here in the Southeast.
That's another good thing about what we do is it's not a cookie cutter type of, yeah, we can do it or no, we can't. If you have that discussion with me, hey, here, I have a subcontract, it's working on a GC, it's for this end user retail. I just need ammo to take to underwriting and see what we can do. Like Josh said, we're pretty familiar. There's someone in there that knows exactly what you're talking about. We've done it 100 times. And then I just feed that to them and say, yeah, well, we can just do this and this and this and this, and it'll solve the problem. So any aspect of what you're doing, depending on endorsements or anything else, we should be able to have a solution for it.
Information is the key. As long as we can, if they say no, just trust me. But I'm not going to give you access to any of my financial information. I'm not going to secure a $5 million line of credit with that entity. You take the same entity and you're asking me for a $50,000 line of credit as part of a whole turnover type policy with an organization, I might just do it on a wing and a prayer. You know, it's part of the overall spread of risk. So a lot of it depends on the structure of the policy as a whole and how much credit you're looking for.
This is one of the largest objections that I hear when I'm talking with someone. It's either when I get the CFO on the phone, I don't need this, I don't have any losses, or my clients are good. I know who my clients are. I've been selling to Bill for 30 years. I went to high school with him. He's not going, banker. You'll hear stuff like that all the time. It's not someone's unwillingness to pay, it's their inability, depending on what sector they're in. Something can come out of nowhere where it's not that they are they're just in a position where they cannot give you the money. And that's why we've been able to do this for 120 years and write 40% loss ratios into our business plan. Because it's not that we just insure the good accounts, we insure the insurable accounts, and we know information that you might not know. Where we've been in meetings where you're sitting and talking with the client, they say, why won't you insure this account right here? Maybe we have updated financials and they are terrible. And they don't know that because that's their biggest client. So they're slow paying these little guys to death, but they're paying this guy on time every single time. So there's no way that they would know that they're being slow paid, they're slow paying other people. That is what you're paying for. So they say, why would you give me $200,000 on this one? And we tell them the story about it, of what we can and what we can't share. It blows them away. So a zero or a limited limit is the best thing that we can tell a client. If I blindly have 100% coverage on somebody, it makes me nervous to go in there and present this because, maybe they are as good as gold. But if there's some people with information gaps that may not have, that I have the intel on what it is, that is crucial information to them. And that's what they're paying for.
Two things I like to point out here. Every business has a life cycle. Every business has a life cycle. 2 weeks ago, the largest coal company in the United States started in 1833, a company called Peabody Coal, filed for bankruptcy. Been around for 180 years. Every business has a life cycle. The question is, where do your customers fall in their life cycle? Are they at the beginning, in the middle, or are they nearing the end? But the other thing I always point out, and these guys or whoever else you're selling to, you can control how you credit underwrite your customers all you want to, but what you can never control are their customers. And unfortunately, you can't control how they're paid by their customers, how well they manage their AR with their customers, and all it takes is one loss on their end for that to domino to you. And you can't see that. You can't, no matter how much you monitor and manage that, you just can't see it.
And the basic credit function ability of a company. So here's another example. Euler Hermes seems to know about every one of our customers. They have a vast amount of knowledge and provides us with information needed to pick up the right new customers and raise limits on their current accounts. I want the CFO to be the CFO. I don't want them to be the credit manager. So when I'm talking with someone and they'll say, well, I'll have you talk to my controller about this, and they can bring it up. I need to talk to the CFO about the strategy of where they're going with that company, and if they're getting pulled, or let's say it's the owner of a company that wears 15 hats because it's a family-owned business and he started it and he did everything he could to get this going, he's not about to delegate out to somebody else that AR, because that AR is his money. And I love talking to family-owned businesses that have been doing it, they've handed down to somebody else, because their AR is their retirement home. It's everything they've done. It's not a different CFO looking at it in an abstract way. That's super valuable money to them. And they like to know that it is secure. So I want the CFO to have the ability to work on the strategies and implementations of the company versus chasing collections and credit all day long. And it's not about getting rid of their current controller, which will get pushback on that as well. If they're in growth mode, like Josh said, instead of hiring another credit manager because they're doing well and expeding all these things, hire us to take on and assess the credit all day long and do the minutia of the day in and day out. And then you don't have to hire another person, or you can just solidify the work that current controller or treasurer or director of finance is doing. And we don't get sick, we don't take vacation, and if we're wrong, we guarantee that you will get paid on it. Every credit manager knows an account that is burned and they thought they should take on and they got burned by it, every one of them. So we do the same thing as well, except we provide the guarantee behind it and do it in 24 hours. It's domestic. Company to make a credit decision. Where do we get all this information? We've got verticalized risk underwriters in those sectors that are looking at. So when I'm talking to someone in automotive, I know the underwriter to call that knows everything that's going on with that. Retail, chemicals, food, logistics, staffing, all these people know what's going on with these industries much more than I do. If I have 4 appointments in a day with 4 different verticals of 4 different sizes, a privately held staffing company that does 20 million in sales, and then a $300 million food company selling to Western Africa, you know, those are totally different needs and concerns.
Okay, so how does this work? So I'm the business and I've got a $200,000 new customer. So I put that into your database.
Right.
It says good to go, and then it's an endorsed new premium, additional premium?
No.
No.
We base the premium off of, that's the next one, off of what you own, annual sales, things like that. But like I said, you should be adding clients and new projects as you go. And then at the end of the year, there's a true up based on,
There's an option.
yeah, hey, you did 20 million in sales.
It's not that different than like a general liability.
Right, exactly. But yes, that is a perfect scenario of, take me through how you take on a new client. Oh, we do the bank and trade registers, DNB, we check, give me, I'll have the iPad out, give me the name of the account. It's, you know, CW Contracting and something like that, CW Matthews Contracting, we're looking at that project. I can do 200,000 on them right now. Really? Yeah, so if they had access to it, they would type it in, Tyler Parker Incorporated, $200,000, and I'm going to give them a decision. And it has a risk rating attached to it, 1 to 10. So 1 is Walmart, 10 is Enron, Circuit City, uninsurable doors are closed, and everyone else is in between. 1 through 4 will give us 12-month audited financials on files that we have for that client. And then there's also the big hitters, Amazon, you know, those are the 1 through 4. Everyone typically falls in 5, 6, 7. That's kind of the middle of the road. When I'm seeing like, what are we rated? Everyone always wants to know that number as well. 8 typically means we don't have information. We have lack of information. It's an LLC that just formed 2 months ago, and we ping it off of our database, and it comes back with an 8 because we don't know who they are yet. So now, if we work with you or do our own job of trying to get information, then yeah, the grade can fluctuate and look at it. And that's all we do is monitor and assess risk and credit on a daily basis with those 6,000 employees. 9 is information, and it is negative. And then 10 is change on the board. But again, everyone typically falls in that scenario. And the other thing is when you get to a buyer grade and the country grade, same thing as before, obviously that gets to just as risky. If I have no information on someone in Western Africa, that's going to be a tough one to get the information to get on there. But again, that's what you're looking for. That's why we grade these people. And this is a tool that your policyholder will have once it gets implemented. How fast is our response time to these credit limit requests that you're putting in every single time? So you know when I'm taking on new business, how quick I'm gonna be able to get that decision back. The fluctuation of the credit limits, how high are these limits? What's the acceptance rate that we're going? So when you look at your portfolio, and they're all risk grades 6, 7, and 8s, you take a look at your client base like, man, my portfolio is a lot riskier than I thought it was. And as we update these people every year, they can go from insurable to non-insurable and back again, so it makes it as good.
That's done yearly, that's not done as.
It's real time.
Real time.
Oh, it's real time. Okay.
Yeah, our grading system was created for our shareholders. They wanted to know of your 50 million accounts that you're insuring and have exposure to, is it an average weighting of 3.2 or 7.1? Because that's going to affect.
And is that
liability
pushed
risk.
to the client? Hey, when
That's
you're
what this
big,
provides you.
It will push it to
You
you,
can now,
and guess
yeah.
what? One of your guys dropped.
That's exactly
Yep.
right. You now know on a real-time basis, the average risk grade of my portfolio is 4.3 or 6.2. So you know, hey, my business has grown 15% this year, but the average grade of my clients has decreased by 2 points. So yes, you have a larger, riskier portfolio versus a larger, less risky portfolio. Our policyholders begged us for this for years, and we finally figured out a way to take what was an internal tool and provide it to our clients.
So they can see it instead of us meeting with them quarterly and saying, hey, here's the fluctuations of your buyers. They can see it at real time, just like you stated. So if I ever am speaking with somebody, they actually get to the point of every single meeting goes to, how much does this cost, right? And they're gonna wanna show that to the owner, show it to whoever else. This is how we come up with the pricing. It's a 1-year agreement. We base it off of what you do in annual sales, who you sell to on what terms. So am I on 30-day terms domestically, or am I on 90-day terms in India? And am I in this sector or am I in that sector? That comes with a premium rate factor, and that's the basis points that we use. We calculate the annual premium down to what they will pay minus deductible or non-qualifying loss. The non-qualifying loss is, the rock against the windshield, so to speak, of the very small aspect of, hey, this is not why we're here. I'm not here to file a claim on a $500 limit. I'm here for the larger limits of what you're trying to accomplish. So that's, again, all of these are scalable and can be interchanged, and everything is, it's not that I show you this price and that's it. It's, you can talk and discuss anything with these aspects, but that's typically how a normal policy is printed out.
Just insurance 101, right? And
Right.
an alter risk share.
And that, so when you're talking with someone, it's going to take me about a week from application to turn it around and look at it. Unless all the buyers are international, might be 15 to 20 business days. It's something that I have to say, but probably be quicker than that. But when you get the application, it's going to take me about a week to get it into underwriting, get the buyers looked at and reviewed, the pricing structure from the commercial side, and then the risk side looking at the buyers, come back and present. It takes about a week. If something needs to be rushed, it can definitely be rushed, like anything else. But that's about the typical time frame of what it is. You take it back in a week and review it. They say, I like this, I don't like this. We tweak what we can tweak, and then implement the program. Coverage is enforced, and they hopefully begin doing what they do.
So how frequently are premiums adjusted as the risk profile changes throughout the year?
It's more so changed in a positive way due to maybe they wanted a low premium. So maybe they said, our sales estimates might be 20 million on this. And now halfway through it, they're projecting 30 million. I might be able to blow up that policy and rewrite it at a better rate just due to the fluctuation of sales growth.
We'll commit to our risk profile for a full year.
Right.
So
It's a 1-year contract period, so we're not gonna change rates based on risk changes for the first year. We'll simply reassess every quarter. The only thing that would change would be a major change in either direction. We expect them to. I mean, we're gonna give them tools to add buyers to their policy. That's why we write this as a sales-based policy. A decade ago, we did everything coverage-based. You paid for the coverage that was approved. For a company that had 600, 700, 800, 900 accounts, sometimes more than that, it was a nightmare. Every time they added a buyer or took a buyer off, they owed me premium, I owed them premium. When do you reconcile? It was impossible to track. So they said there's got to be an easier way to do this. So we wrote it on as a sales-based policy. Now they essentially operate as they operate for a year, and we true it up at the end of the year, barring a major change in the middle of the year. You know, we
So
saw,
let's take the Sports Authority example. You have a company, you underwritten it to, we do $1 million at Target and Walmart and Sports Authority. And so here comes Sport. Do you then tell them, don't sell to them anymore? Is that part of your,
we can, yeah.
yeah, we are not, they're
Well,
well
they're not
insured
insured
to this
after a
minute.
certain point.
Right, and we
Right,
did.
but moving forward, yeah,
And we did that with Sports Authority.
moving forward, you're out of line.
Call it 5 months before they filed, we saw the writing on the wall. We were still insuring, I got a $200,000 limit approved for them sometime late last year. But by early this year, we saw that, you know, that we were tired of bailing water. There was no sense loading people on the ship as it was sinking. So yeah, at some point, we will reach our level that says, okay, no more is approved, and we'll even tell our current policyholders, all your insurance is effective to this date, and then we'll generally give you 30 to 60 days to go ahead and fill any orders you've already accepted or continue to sell to them. But effective a certain date, any new business you choose to continue to take on, it's now a business decision, it's not a credit decision. The writing's on the wall, and that will be a self-insured decision.
Country restrictions, so if there's some political issues,
Yeah.
it'll go the same way.
You're right.
What about, like, if somebody does file and you were insured on them, does that trigger a quicker claim resolution because it's a, you know, kind of
Possibly.
a more direct line in the sand?
Maybe, but
Yeah,
they
let's
still
get
have to be
that letter.
scheduled on the Schedule F. So that has to be scheduled, it has to match what they've claimed. Okay, so the bankruptcy court has to recognize that the amount that they've claimed is the amount that's owed to that buyer. So we will wait for the schedule to be released. And then we compile all of our unsecured debts. So especially for some of the major companies, Kmart, for example, when they filed for bankruptcy in 2001, single largest bankruptcy filing in our domestic history. We were the largest unsecured creditor in the bankruptcy. We chaired the bankruptcy committee because we compiled all of the unsecured claims that we have, and that's how we handle bankruptcy. So your $100,000 claim may be simply a part of $1 million unsecured claim that we take. So we'll compile all of that, we'll represent our policyholders as a group, and try to recover whatever we can, because keep in mind, whatever we recover, A, we share in it, depending on your risk share in the policy. So if you had a 10% co-insurance, you have a 10% interest in anything we recover as well. But B, it also impacts your loss ratio. So if you file a $100,000 claim and I recover everything out of bankruptcy court, then that comes off your loss experience for your policy. It impacts your rates going forward. So there's some benefits to how we handle bankruptcies.
When you have bankruptcies that you deal with and you aggregate all your clients, does that put you higher at the table?
Lots of times, that's the goal.
Yeah.
That one it did, right? You're
Yeah,
chairman.
I mean, we made money off the Kmart bankruptcy. We walked out of there with stock options and all these other things. So once they emerged, over time, all of our policyholders were made completely whole, and it ended up being a profitable bankruptcy for us. They don't always work out that way. And keep in mind, we do a lot of privately held small companies where they may shut the doors and you're the only $100,000 claim that we received, and we're just as out of luck as everybody else.
Can you speak, you shared some information with us recently from the product for private equity buyers or private equity funds. Is there any specifics you can speak to? I know it's not in the program. We've got at least one person here, and there's a number of us that, you know, work with some private equity funds. In terms of how you might structure.
Yeah, I was talking to Josh, I keep bothering about the private equity companies just because it triggered in my mind a few months ago. I was like, man, private equity company could really benefit from it's the same risk mitigation of what you're looking at. And like I said, it's come from M&A guys down, or it's gone on the buy side or the sell side of, I think the one aspect of putting a true number of value on that asset. You know a lot about that company that you're buying, but you might not know who all their buyers are, or how risky they are, or what they're doing. So we can get the banks much more comfortable with finishing that deal, or it'll come from, hey, the bank would like to get credit insurance on this, and then the private equity person will call me and we get an application in 10 seconds and take a look at it and see what it is. And the cost justification is depending on how you are buying that and what you're basing off what you're looking at, the premium is nothing compared to what you're going to save in money or how quick you're going to win the deal and buy that company. And then now that asset that you just bought is even much more on either side of selling it or buying it, it looks that much better to anybody that is involved in the scenario. So I just kept on looking at it.
Do you see more sellers positioning it to help alleviate due diligence on who their buyers are and speed the process, or private equity after the fact to make sure that if it was part of an existing relationship?
It's per individual producer that gets it, just like any other broker. I mean, some brokers take this and run with it, and some bankers take this and run with it, and some private equity guys who sell, I would do that. If I'm positioning and I'm selling it, their accounts receivable is insured through Euler Hermes.
Statistically, I'd say we've seen it more from the sellers, simply
Yeah.
because we probably haven't done a good enough job educating the private equity guys on A, that the product is out there, and B, the benefit that it provides. Since we've started doing that more and more, I think we're seeing more. Overall, the structure is the same. We're going to insure the widget manufacturer's customers. It's how we get access and the true benefit of why they're buying it. And I think we're seeing more and more of that, of the private equity folks coming to us more proactively to say, I have a diverse portfolio. I don't have the time nor the inclination to do an extensive amount of due diligence on every one of my portfolio companies' individual company buyers. I'd like to put a hard value on that asset. I would like you to go talk to this company and get a credit insurance policy implemented instantaneously before we invest. And so that's what drives the conversation. But then the structure really, from that point, the structure is the structure. It's why they're buying it that's really ultimate. But I'd say historically, yes, it was more sellers trying to increase the value of their company by solidifying the value of their asset. To the market and positioning it as, hey, look at my really attractive company with a concrete asset.
And on the buying side, it was the one that I had, it's someone out of New York looking to buy this company in Georgia, and the bank was talking, he hadn't heard of credit insurance or utilized it on any of his deals, and the bank was kind of talking about it, toying with it. So he calls me, and it's, hey, it's this company, it's this size, how much you ballpark do you think it's going to be? I was like, I don't know, 100 grand. Okay, bye, click. Then they keep working on that deal and keep pushing towards it, and that information gets uploaded really quickly. So it gives you another bullet in your gun of creativity to finish the deal off, or to show it to them. We're an ABL lender or a traditional bank of, hey, if we could lend against the export receivables, we could win this deal. Same thing. It's just, that's why I have to be evangelical about what we're looking at. Or if you're a broker looking through your portfolio, it's just, oh yeah, they want to at least take a look at it or have a conversation. It might not work on that deal, but it will be a deal that it does work on. And that's all it is. And those happen quickly.
I have a question. Since you're covering South Florida, what are you seeing with Cuba? Are you all, having much
Nothing
stuff?
yet. We want to see how this progresses for a period of time. I would say we're.
You don't have an office in Cuba yet.
We haven't built brick and mortar there just yet. Now, that said, Cuba/Miami, right? I mean, we certainly have the influence of there, but we haven't opened up any direct trade lines with Cuba yet. We're going to want to see at least 6 to 12 months of how this progresses and where it goes before we start opening up trade lines. The question has been asked probably a dozen times in the past 60 days from accounts down there. But we're relatively conservative. We're going to see where this goes before we start opening up significant trade lines. That said, there's a huge market for it. So if we can get comfortable with the risk and where the market's headed, and it's premium for us. We're going to look for the opportunity to do it. But we're a for-profit company, and we're going to make sure that the risk we take is profitable.
That's all I have. Thank you guys for your time. I really appreciate it. I'm glad we got some dialogue going back and forth. Like I said, it's just, that's all it is. You just keep having to have these conversations going back and forth.
Strikes us as a pretty cool solution to a lot of.
You just got to make sure you're presenting it as not another line item of insurance that you're looking at. It's just based on your industry and what you do. I think you'd like to have a conversation with this guy to see if it could be a benefit.
That's our biggest challenge, without question, is market awareness. Yeah. Our value proposition in front of the decision maker of a client organization is very, very strong. There's lots of reasons to buy this. They're accepted reasons. The ROI is not smoke and mirrors. It's hard dollars. We can really show it. but we're not a household name. You're Tyler from Hooler Ware, and then they hang up the phone. I mean, you go outside of the United States, and we're a name that people know, we're a name people have heard of. Our market penetration's 50% as far as credit insurance is concerned. In the US, it's just not that way. So our biggest hurdle is just the opportunity to speak to a decision maker in a client organization about what it is that we do. Once we get to that point, our success rates are very, very high. So a big part of what we do, and I like when Tyler uses the word evangelize, we're really just educating the market that this exists. After the 07, 08, 09 debacle, people started looking for opportunities to protect themselves, and we're standing over here saying, yeah, we've been doing this since 1893. We're still here, we're still doing the same thing. Nobody cared for a long time, and now they're starting to care. So they've started to actively seek us out. Now the goal is to be proactive in getting in front of them. There's a lot of value in the product in multiple avenues.
This has been very good, we appreciate you.
Thanks for
Taking the
having
time
us.
out of your schedule to present it to us.
Thanks a lot.
Thanks.